Now, please welcome your presenter, Brian Perry, CFP, CFA. Brian, are you with me today? Oh, look at
Yes,
you.
I am. How are you?
Live from Denver, it's Brian Perry.
Yeah, live from our new Denver office. So new that there's nothing on the walls.
Beautiful. You got to start somewhere, right?
You got to start somewhere. Yeah. Yeah. Greetings. All a little bit different to do this from a desk in Denver versus the TV studio. And, I think there are pros and cons to both. I like the TV studio, though, because I don't have to wear my glasses. I can pretend that I can still see.
Yeah, right.
So getting a little bit older, but that just leads to more market wisdom, which is good for all our clients.
Perfect.
Yeah, so a lot going on, folks, and we thought that it was time to just kind of provide an update on where we're at and, also where we might be going. And I think also we get the question a lot of times, what are you doing or what are you going to do about it? And so I think in summary at the end of this, we'll look at a few slides that talk about why we may or may not do something in the portfolios going forward. And, the reality is, by way of preview, I think that we're pretty well positioned for the environment that we're in. Obviously, when markets are having a rough year almost across the board, a lot of times it's just about kind of trying to wear a helmet and get it over with and get through to the other side. There's not a whole lot of places to hide, but we think that we're well positioned both now and going forward. So let's take a look at some slides, and then as we go along, of course, as questions come in, Andy will moderate and throw them my way. Let's see, I'm going to go ahead and share my screen here, and let me know if the slideshow comes through correctly.
It does. Looks good.
It does. Awesome. Look at that, live from Denver, and it still works. So let's start, folks, with what's happening now. Maybe some of you remember that TV show back from the 70s. I actually wasn't thinking of that when I put that slide up, but I do remember that TV show. And here's the irony is that show What's Happening was made in the 70s and early 80s, a time of high inflation. And now look at this. We're at the highest inflation we've had since the late 70s and early 80s. And to me, this is the story of the year, right? Is obviously back in February, we had the Russian invasion of Ukraine, and that war continues. And certainly the human toll is quite terrible. There have been a bunch of other events this year, geopolitically, economically, et cetera. But I think the central thesis that's really been driving markets is the surge in inflation from basically zero during COVID and from very low levels over most of the past couple decades to north of 8%. And commensurate with that is the Fed's efforts to rein in inflation. And I'm sure I'm not telling anybody anything that they don't know, but life's gotten expensive out there, folks. Gas prices, food prices, whatever, everything's gotten more expensive. So if you're the Fed, you've got two jobs. The Federal Reserve is tasked with promoting price stability and full employment. And there's a little bit of a double-edged sword there because price stability means reining in inflation, keeping prices from increasing too rapidly or keeping pricing from falling during recessions, right? And then full employment is, as the name implies, keeping the economy chugging along, making sure that folks have jobs. Well, right now the employment's pretty good. The job market's pretty strong. You've probably noticed every restaurant, retail location in America has a help wanted sign out, but inflation's out of control. And so the Fed's really focused on that. And so what they've done is instituted a series of interest rate hikes in an effort to slow down the economy and rein in inflation. And it's really a balancing act between can they lower inflation to more reasonable levels, but without slowing the economy down so much that it falls into recession. And I think when you look at what people are worried about right now, it's that the Fed won't be able to accomplish that in their effort to rein in inflation, they'll tilt the economy into recession. And so I want to talk a little bit about what a recession might look like if we do get one. And I think that there's this sense that if there's a recession, the whole economy just evaporates and goes away. There's an old joke that what's the difference between a depression and a recession? And a recession is when your neighbor's out of work, and a depression is when you're out of work. And I think that really speaks to the uneven distribution of the pain in an economic slowdown. What happens is that it's not universal. If you think of the early 2000s, it disproportionately hit technology with the dot-com bust. If you think of 2008 and 2009, it was really construction workers with the housing slowdown, some public workers that got furloughed and stuff like that. So, pain from a recession or an economic slowdown gets felt by a lot of people, but it's not uniform. Some people suffer more because they lose their job or they're in an industry that's disproportionately affected. But the reality is that across the board, a recession doesn't mean that the economy just goes away or that nobody spends money. These bubbles on this slide are the size of the decline in GDP, or the size of the decline of the economy during various recessions. The Great Depression is a big outlier, down about 26-27%. Obviously, that was, hopefully, knock on wood, a once in a lifetime event or a once in a history event. I don't think we're going back anywhere near that. The other two big declines are the World War II, when we came out of that and we demobilized, right? The entire country, the entire world was on a war footing, churning out, guns and whatnot. As that retooled, you saw a big slowdown in the economy. And then the pandemic, right? As you all know, we couldn't go out and spend money. We were trapped in our houses. And so the economy shrunk by about 10%. If you take those out, the average recession has seen the economy shrink by about 2 or 3%, right? So again, some people are suffering disproportionately in those environments. But if you think about it, what a recession is somebody that goes out to eat every Tuesday and Thursday of the year might go out to eat 2 less times a year. Somebody that stays in hotels, I don't know, 15 nights a year might stay 14 nights. So it's a reining in of economic spending, but it's not a complete shrinkage or collapse in economic activity. It's very marginal for most people, again, with some people affected disproportionately. Yes, Andy.
Brian, we've got a question from Tricia. She says, what is your definition of a recession, since you're not using the classic 2 quarters of negative growth?
Yes, that's a really good question. So traditionally, as a rule of thumb, and there's actually a slide on this here in a bit, is that it's 2 consecutive quarters of negative GDP growth is a recession. And even the popular media and stuff will throw that around, but it's actually not technically correct. A recession is determined by the National Bureau of Economic Research, the NBER. And what they're doing is they're looking at a variety of economic factors. GDP, or declines in GDP, is one of them, employment, a whole host of factors. And they go in and they date recessions. It's not the most useful information because a lot of times it'll be after it happened. They'll say, whatever, a recession started in January and ended in July or something like that. But in the meantime, you're in, October or something. So they're backward looking a lot of the time as far as dating recessions. A decent rule of thumb is 2 consecutive quarters of GDP, which we are currently experiencing, but we haven't technically been declared to be in a recession yet. And frankly, I don't know if we are or not. There's a slide in a little bit, though, that I'll show that looks at both times when we were officially in a recession as well as times that we had 2 consecutive quarters of GDP, and then looks at how stocks have done in those environments. Speaking of stocks, I should have run this slide through yesterday instead of through a couple of days ago because it looks a little bit better. Obviously, it's been a poor year. We've had a couple of legs down where we fell basically from January into the spring, recovered a little bit in early summer, and then have fallen off again. Performance was quite bad through most of last month. We had a couple good days this week so far. If you stretch the scale out, though, going back to 2010 or 2012, excuse me, you see that stocks are up about 2.5x in that time. So the long run average is quite a bit higher, with some volatility certainly around COVID as well as more recently. And that really speaks to the way that stock markets work, is that over time you expect to get reasonable returns. But that they're very lumpy, right? You had a long stretch of positive performance, a sharp sell-off during COVID, another big rally, and then some more sell-offs. And that's the nature of stocks, and which is why we always circle back to the financial planning and the idea that the stocks are in the portfolio for cash flow needs years and decades down the road, not short term, because of the volatility of stocks. If you look at bonds, interest rates have gone up significantly, as you all know. So if we look at 10-year treasuries, they've gone from about 0.5% to about 3.6 or so. They actually hit 4% at one point. So from 0.5% to 4% in 9 months is a tremendous move higher in the in interest rates. But when you look at it stretching out the scale, the left-hand side is 5 years, and you see that while we're a lot higher certainly than we were a year ago or even 6 months ago, we're right back in the range we were back in the late 20 teens, right? 3.5%, 4%, 3%, something like that. So a big decline from, call it 2019 through the pandemic, and then a big recovery, but only back to that range. And then on the right-hand side, if you look at treasury rates longer term, this is 40 years, and you can just see that even though we've ticked up recently quite a bit, it barely registers in the long run decline of interest rates. And the reason I bring that up is, right, there's a lot of talk about housing and mortgages right now. And 6% mortgage, which sounds like a tremendous interest rate given what we're used to. A lot of people have 2.5% and 3% mortgages, and now we're at 6 or 6.5. And relative to the last 5 or 10 years, we are at higher levels on a lot of these things. But if you look at the broad span of history, interest rates are still reasonably low. And I think that's important to keep in context, is that interest rates right now are at a level that will slow economic activity. There's no doubt about that. But they're also not at a level that's going to choke off economic activity in and of themselves, because in a historical basis, they are still relatively reasonable. One of the impacts, though, of rising interest rates is bond prices have fallen. And for those that aren't familiar, when interest rates go up, bond prices fall. And when interest rates go down, bond prices rise. So there's an inverse relationship between interest rates and bond prices. And with the increase this year in interest rates, we've seen a sell-off in bond prices, as some of you are probably aware. This chart has a bunch of squiggly lines going on, but what it looks at is the annual performance of the bond market every year for the last 4 decades. And what you see is a bunch of numbers that are kind of lumped in there in the middle in those gray lines. You see a green line at the top where that was 1982, and that was far and away the best performance. And then you see a dark blue line that's far and away the worst performance, and that's 2022. The reason I bring this up is not to sort of emphasize like, oh my goodness, it's been a terrible year, but more to show just how unusual this year is. Because if you look at this slide here, you can see just how much lower the performance is, or how much worse the performance is in 2022 versus every other year here in the broad middle. And the reason I emphasize that is I think that it demonstrates that the performance is unlikely to be repeated going forward. I don't have a crystal ball as far as what the future for bonds holds. But I do know that anytime in financial markets you get, a multiple standard deviation event, something that's completely out of the norm, those things happen more than statistically they should, but they don't happen again and again and again. And so I do think that while bonds have had a tough year, the benefit of the decline is A, it's a one-off and it's unlikely to continue indefinitely. And B, interest rates are far more attractive now for bondholders, providing more income to retirees than they would have otherwise, which does bode, all else being equal, well for bonds going forward. When you look at other types of assets, there's a common perception that gold is a place to hide in times of uncertainty, and particularly times of inflation, right? Gold is an inflation hedge. And to me, this year has really disproven that. When you look at the inflation that we've had, which is the highest since the 1970s, and then you look at gold, and not only has it not protected portfolios, it's actually down just as much, if not more, as stocks. I think if you're a fan of gold, it has to be a little bit disappointing to see that you're in an asset that you thought would provide inflation protection and it's done anything but. And in fact, you could have owned stocks and been just as well off, or as poor off as the case may be. And of course, in times of when stocks are going up, when the economy is good and stuff, you don't get those strong performances from gold. So if we were to stretch out the horizon, this year gold has done just as poorly as stocks. If you run a longer term chart, stocks have trounced gold. And I think this really calls into question the role of gold as an asset class. The kind of quasi gold, or the new gold, if you will, is cryptocurrency. And this is another asset class that there was some question about how it would do in different environments. And certainly this is just Bitcoin. There are other cryptos out there, but Bitcoin has had an abysmal year, down roughly 2/3 or so in the last 12 months. So certainly not an inflation hedge to date. And I don't know honestly if crypto needs to be that. We're not opposed to crypto. I actually think the underlying blockchain that supports crypto is fundamentally a game changer to a lot of different industries. I think it's here to stay. And I think that some cryptocurrencies could be used as means of transfer payments when the blockchain is used to settle transactions and stuff. I think it'll potentially revolutionize some of the back end plumbing of finance, energy transfer, et cetera. So, certainly not here to say that cryptocurrency is a terrible investment or anything, but it is pretty darn volatile. I don't think it's necessarily an inflation hedge. And it certainly has not had a good year or been a place to kind of hide out in the interim. The one other asset class I want to talk about before shifting to the next section is the dollar. And there's a question we get a lot of times is the dollar going to disappear, or what's going to happen? And there's a lot of people out there that don't like the political direction of the government. And that's true all the time, right? No matter who's in power, probably 40 or 50% of the people in America think it's wrong, and 40 or 50% of the people like it. And so there's a lot of concern about, whatever party's in power, a lot of concern about the role of the US around the world, inflation, et cetera. And so we get questions around, hey, is the dollar even going to survive or something like that? And the reality is that the dollar's had a great year. You know what I mean? So far from not surviving or the dollar going away is the fact that the dollar is up significantly on the year and has trounced every other currency. And in fact, you saw last week, the Bank of England, which is the central bank in England, had to come in and support the British pound because it was collapsing against the dollar. The dollar had hit the strongest level against the pound since 1985, right? The dollar is at parity now with the euro. So the dollar is super strong against the euro. And so, although there's concern about the US, and certainly we've got our issues both in the short term and the longer term, whether it's politics, the economy, the national debt, et cetera, remember that all currency is relative. And if you look around the world, and you're not going to own the US, what other currency would you want to own that doesn't have any issues? I think every country has its own issues, and the dollar has, relatively speaking, been a winner. I'm going to shift to what's on the horizon, but Andy, any other questions we want to draw on before we do?
At this point, there are no questions. If you do have questions, go ahead and type them into the Q&A, and Brian will get to them just as soon as he is able.
Great. All right, so let's talk about what's on the horizon. Well, for starters, some of this is just historical, but I think context is helpful. And there's the philosopher George Santayana said that history doesn't repeat, but it rhymes. And I think we need to keep that in mind when we talk about historical precedents and financial markets, is that just because something's been one way in the past doesn't guarantee or even, hint that it's going to be the same in the future. But I think if you see cycles that occur again and again, or patterns, it at least tells you that although the circumstances might be different in a given environment, it's really not different this time. And this chart just looks at bull and bear markets going back, to the 1920s. And I don't necessarily even care about the numbers on here. What I care about is the fact that there have been a lot of bull markets, and then each one has ended, and there's been a bear market. And then there's been a bull market, and then there's been a bear market, and then a bull market, and then a bear market. The point being that this is part of the process. This has happened again and again and again. And one characteristic of financial markets in the last, probably 30 years or so has been that bull markets have been a little bit longer than they had been in the past, and bear markets have been a little bit shorter. And so I think it's easy to forget that sell-offs are part of the process. And that's why when we map out cash flows and financial plans, we're looking at it, okay, what's a reasonable expectation for a return over the next couple decades? Settle on a figure that we think is a good average, knowing that in almost no year is that average actually going to come about. There's going to be good and bad. I mentioned with the questioner a little while back about the 2 quarters of negative GDP versus an actual recession. And so this chart has a couple instances where there was a recession and a couple instances where there wasn't. So like this top one, you had 2 consecutive quarters of negative GDP, but there was not a recession, highlighted in yellow. The pink are times that there was a recession, but there was not 2 consecutive quarters of GDP. And then in the remaining circumstances, there was both an official recession and 2 or more quarters of negative GDP. So you can see that oftentimes when you have negative GDP for a couple quarters, you have a recession, but not always, and vice versa. But I think without doubt, each of the periods listed on here is a time of economic slowdown, if you will, right? No matter whether or not it was an official recession. And what I think is really important to focus on is the performance. So during that recession, you can see the average return, 2.4% from stocks during the recession. Not great return, not huge, right? That's not the historical average, is closer to 10%. But the reality is that on average, during economic slowdowns and recessions, stocks have actually posted positive performance. And I think that's important to keep in mind with hey, is it time to abandon stocks? Again, we don't have a crystal ball of what's going to happen next month or next quarter, but we do know that a lot of times as you either get in a really bad environment for stocks, you slide into a recession, interest rates are high. A lot of times because stocks are a leading indicator, they've already sold off and they actually find their footing during the recession and then, certainly recover out of it. Where if you look at US stocks a year after the recession, the average return is actually positive 22%. And that speaks, I think, to the idea that the best time to buy stocks is when the news is worse and when prices are down. Historically, that's provided the highest returns. One other interesting data point to me is here are the 20 best months for stocks. And the reason I brought this up is this past July, so just a couple months ago, was one of the 20 best months we've had in the stock market going back, 50, 60, 70 years. So since the 1950s, right? So July of 22, we were up 9.2%. The next month in August, we were down 4%, and then last month we were down as well. So certainly the performance following that stellar June has not been good. But what's interesting is look at the column with the 12 months later. So anytime that you've had one of the best months in history, 12 months later, the average return is up 18.5%. So I don't know if that really strong month is telling you something, that things are going to get better or whatnot. But there is a historical precedent for when you post a strong number, it doesn't mean that you're immediately going to continue to higher, but it has been a pretty good indicator that things will get better going forward over the next year or so. The other thing I want to talk about, if we look at the path ahead, is the election. I guess the one bit of good news, if you want to call it that, with high inflation and all of the kind of uncertainty we've seen this year, is it seems to have damped down a little bit to talk about the election. And certainly we're about a month out now from congressional midterm elections where both the House and the Senate are up for grabs. I think consensus, so we had a political analyst who's an expert on the Washington landscape speak to us last Friday as a firm, just to get a sense of what's going on. And his conclusion is that that the Democrats are likely to lose the House, that the Republicans are likely to gain control of the House of Representatives next month. Although he doesn't think it's going to be as big of a landslide for Republicans as it would have been about a couple months ago, but he does think Republicans will take control of the House. He thinks that the Senate is basically a coin flip and that it could go either way. He's leaning towards the Democrats keeping control ever so slightly of the Senate, but he said it's going to be super close. But the bottom line, I think, is that regardless of what party's in power or whether it's mixed, is that stocks have gone up in a variety of regimes. And so, I've said this before as we come up on elections, but I think it's really important to vote. I mean, that's our right as Americans, have your political views, try to get your causes enacted, but then ultimately separate who's in office from what's likely to happen in financial markets, because there's an upward momentum to stocks across time that's played out regardless of who's in power. And maybe the reality of it is that, the stock market and capitalism and corporations making, Disney World making rides kids want to go on and stuff like that. Maybe that's just so powerful that no matter who's in Washington, they just can't mess it up enough or something. I don't know. This is just another way of looking at that, where you can see that we've had on the left-hand side, united government, where one party's in control of the House, the presidency, and the Senate 50 years or so. And you can see positive returns. And then we've had divided government about half the time, and again, double-digit returns. And then you can see during the midterm what happens. If a party loses control of the House or Senate, you can see you still get positive returns. And if they maintain control, you still get positive returns. So obviously there are some differences in the size of those returns. But again, who knows what's going to happen, but based on historical precedent, no matter what happens here in November, there's no historical data to hang your hat on that would say, oh, stocks are going to fall significantly because X happened.
All right, so we've got a couple of questions that have come in. Given the adverse outlook for energy, fertilizer, and food shortages in EAFE and also emerging markets, would it be a good tactical shift to reduce underweight foreign equities for the next 2 years? I have a 60% equity portfolio that is a third foreign. I'm thinking of selling half of that foreign for domestic industries benefiting from the last several domestic spending bills. Your thoughts?
Yeah, it's a really good question. Maybe I'll start at the tail end of it and work my way back. As far as the domestic spending bills, like out of the infrastructure bill, not a single project has actually been funded yet. So you have to keep in mind that there's just an absolutely tremendous lag time in when these things take place. And so while some companies can benefit, it's a very much of a slow drip. The flow of government money does not generally happen quickly. Certainly we like U.S. companies, and it's really tempting to say to get out of international for both the reasons that were just mentioned, as well as the fact that, let's call it a spade a spade. The performance of international markets has not been good relative to the U.S. for a long time now, right? And so it's really tempting to get out. And I'll be honest, it's something that we talk about a lot internally, and we look at it, we say, hey, are international companies ever going to have their day in the sun again? And then the flip side is one of the things that you all hire us for is to have that discipline and to not throw in the towel just when things seem the bleakest. And so it's something we're certainly looking at. What I would say is that, in a variety of different metrics, whether it's valuations of the stocks, whether it's dividend yield, international companies look cheap right now relative to historical averages and relative to the US. You've got a scenario in which certainly the news flow in Europe in particular has been terrible, right? With just being more affected by some of the energy crisis with Russia and Ukraine and stuff. But again, remember that usually stocks do the best when news is the worst, right? Or coming out of when news is the worst. And then you've got the dollar at really strong levels, and a strong dollar is bad for foreign stocks, right? But I don't know, trees don't grow to the moon. So at some point the dollar will reverse and a different currency will rise, relatively speaking. And so I guess all of that makes me say, no, I wouldn't be necessarily reducing international equities, but I will completely acknowledge that it's really tempting, both because of the bad performance recently, or the relatively poor performance, as well as all of the specific issues the questioner referenced. But I think this is the time to stick to discipline. And, as painful as it might be, there's still great companies abroad that aren't domiciled in the US, and economies that are going to rise and fall at different paces in the US.
Another question: for planning purposes, do current stock prices in an environment of massive government stimulus actually relate to past data?
Yeah, I think so. And the reason I say that is there have been a ton of different environments in the United States, right? I mean, there have been, yes, we've got a time of massive government stimulus, but we had a time of massive government stimulus post great financial crisis, and stocks had a phenomenal decade. We have very high debt to GDP ratios, but they were even higher after World War II. And, we had a great stock market in the 50s into the early 60s. And so, again, history doesn't repeat, it rhymes. There's always something that's different. And there are challenges the US faces, no doubt. Do I worry about the level of the debt? Not so much, no, I don't. But do I worry about potentially higher taxes and the impact on economic growth? Yes. Do I worry about just, the crowding out effect of slightly higher interest rates causing, capital to flow to less productive uses? Sure. I mean, I think that there are always challenges that we face. But I don't think this time is that tremendously different that speaks to stocks not doing well going forward. Exactly when they start going up, I don't know. But, I think the other thing I would say is, coming into this year, stocks were expensive. There's very little doubt that they were, relative to prior times, they were somewhat expensive. They're a lot more fairly valued now. So I don't know if we're at the absolute bottom, but we're certainly, if you think about, at the end of the day with investing, if you think about two apartment buildings, I'll use a real estate example. Let's say you were going to buy a rental condo, and there's two buildings right next to each other, and they both have a 2-bedroom, 1-bath condo. Very, very similar. They can both rent for $1,000 a month, and one is for sale for $300,000, the other is for sale for $250,000. All else being equal, the one that you would pay $250,000 for is a better investment, right? If you're buying a series of cash flows and you pay less for that, you're better off. Well, the same principle applies to the stock market. If you pay less for future cash flows of corporate America, you're better off than if you pay more, right? So, that's why we always favor value stocks, or generally favor value stocks, is because you're paying less for the cash flows. But B, stocks are 20% cheaper than they were in January, and is the immediate outlook as rosy? I don't know. I mean, I would say the outlook wasn't that rosy in January, and it's, not that bleak now. But if you look out over the next 5 or 10 years, is the outlook for corporate America that much different than it was in January? I don't think so. But you're paying 20% less for corporate America. I think that's actually a good deal, not a bad deal.
All right. As a reminder, if you do have questions, go ahead and tap that Q&A and type them in. We have one more here. How often does Pure rebalance portfolios? I know it depends on a client's portfolio allocation, e.g. 60-40, and how far those investments trend outside those bands. However, it doesn't seem in this 20% downturn that there has been much activity in my personal portfolio.
Yeah, it's a really good question. The answer is it depends, and because it's not based on time, like the questioner reference, it's based on relative performance. You're right in the most recent leg down, and one of the reasons being is, keep in mind that you're rebalancing relative to each other, right? So if everything's falling, everything's reasonably in proportion, right? And similarly, if everything's rising, everything's still in proportion. And so it's not necessarily just the move, it's the move relative. So if you think earlier in the year, there's probably more rebalancing because you had a period where natural resource stocks were doing extremely well while a lot of things were falling. So it was about trimming natural resources exposure to buy something else. And then, maybe in the middle of the year with some accounts, it was maybe short-term bonds were holding steady, but stocks were falling, or growth stocks. So it was selling short-term bonds to buy stocks. But in the last, several months or something like that, it's been kind of uniform with a lot of things declining. And so relative weights haven't changed that much. And that's really what we focus on is what's the weight of one asset class relative to another, rather than how much time has gone by.
All right, it's back to you.
Cool, thank you. All right, so and I think that last question was actually probably a perfect tee off for this next section, which is what should we be doing, right? So this is where we talk about like what should be happening in portfolios, what changes, if any, should we be making, what are we looking at? And I want to start by talking about, and this is based on a famous study that's done every year, and I've probably showed some version of the slide before, but what I'm about to show looks at the performance of different asset classes and investment mixes over time. And what you can see is this is for 20 years. And you can see the annualized performance of real estate investment trusts, emerging market equities, the S&P 500, small caps, high yield, et cetera. So for instance, you would have been better off in the last 20 years owning emerging market stocks than you would have, let's say, like the S&P 500 or something, right? You can see a 60-40 portfolio, you'd get 7.4%, a 40-60, you would have gotten 6.4. Which asset class and which mix you buy is really important, but I want to highlight the yellow bar with the average investor, right, at 3.6%. So with the exception of commodities and cash, the average investor did worse than every asset class available. Right? And you ask yourself, how is that possible? And think about it. You all probably know somebody that when the market falls, they sell and they get out because they just can't take the pain anymore. They realize they were taking more risk than they're comfortable with. Or conversely, when things are really good, they're, I'm sure it's none of you on this call, but we've had clients mad at us during bull markets for owning bonds, right? And it's like, sell all my bonds, put me in stocks. And it's like, well, there's a reason that you're in bonds. And, so the reality is that a lot of investors are their own worst enemy, and they get into what's been popular and pay too much, and then they abandon ship at the wrong moment. And the result is that the average investor has really underperformed almost every asset class available. And to a large degree, I see the role of your financial advisor and of Pure Financial to help you essentially get these returns rather than this return, right? So to me, the delta between this, which is what the average person gets, and what all the investments gets, this is what I hope that we help to fill, is by keeping disciplined when times are tough. And I think that circles back to the question about is it time to abandon or reduce international stocks, right? And again, it's really tempting. And if the environment changes, we will. I mean, if truly there's a fundamental change to international investing, then yeah, absolutely. We're not blind to new information. But if it's just that it's been a painful period, we don't want to make a decision based on recent pain. We think our job is to not do something in that instance. And then of course we could discuss whether, are the changes to the international landscape, whether it's energy in Europe, et cetera, are they fundamental drivers of, long-term under or outperformance? I would argue that they're not. I think that there are certainly headwinds to various markets, but I don't think anything that's occurred either in the international landscape or the US is doomed for international stocks over coming years.
All right, we have another question. REITs have done very well in the past 20 years. Why has it done so well over the long term? What's the outlook? And do you think investors should have more REITs in their portfolios going forward?
Yeah, well, I mean, we could probably do, a whole hour on that subject, but I'll touch on it at high level. So yeah, so REITs are real estate investment trusts. In this case, they're publicly traded real estate investment trusts. A lot of the private ones you get locked into and have high fees, and we're not necessarily always fans of them. But the publicly traded ones trade like stocks and own different kinds of real estate. One of the big reasons they've done well, I'll name two. One is that, keep in mind, the time frame we're talking about includes 20 years, and if you think about real estate in the first part of this survey, did phenomenally, right? I mean, obviously it blew up in 2008 and 2009, but you had a long stretch of really, really strong performance that you're baking into this. And then in a really low interest rate environment, REITs tend to provide pretty good cash flow or pretty good yields. And so in an environment of zero interest rates, like we saw in the last decade, a lot of investors flock to REITs in order to get income from their portfolio, which helped drive some of that performance. We do own some in many portfolios. Many of you might have some in your portfolio. We view it a little bit as like we want an allocation, 3, 4%, 5%, rather than a huge proportion for a couple of reasons. One is REITs are sensitive to interest rates, and a lot of times when interest rates go up, they don't do that well. Two is that if we ran volatility, like how volatile is an asset class, REITs would be in the lead on that as well. They're also, in addition to the highest returning, they're also the most bouncing up and down. And so if we put half your portfolio in real estate, you'd either have a heart attack, fire us, or be up all night staring at the ceiling, or maybe all three in some order. So we don't want that outcome, certainly, especially the heart attack part. But the other part of it is not everybody, but many people own either a rental property or a home or something like that. So when you think about the role that real estate plays in your net worth, it's larger than what's just in your portfolio, right? And so you might have additional real estate exposure that's not in your liquid assets, and we want to keep that in mind as well as far as how we size the real estate position.
For my moderate risk 40% bond allocation, half is core corporate and the rest is short-term 1 to 5 years domestic and foreign. There are no high yield bonds. What factors would support shifting some to high yield corporate? Some funds focus on CC, but others focus on B or BB ratings. Why not add some B bonds? If so, how much of the 40% allocation would go to that type?
Yeah. So the answer to what factor would support it is your risk tolerance and your return goals, right? And so we do use high yield bonds in client portfolios. Some of the people on this call have them and some of the people don't. And it really depends on your risk tolerance and what you're trying to accomplish. When we use them, we essentially take a fifth of the bond position and put it in higher yielding bonds. We think that, at the end of the day, and this is a little bit of a loaded statement just because bonds have, again, they've had their worst year in my lifetime, and I'm pushing 50, right? But in general, bonds provide stability to a portfolio. And even in this abomination of a year for bonds, they've still outperformed stocks. They've still held their value a little bit better, particularly shorter term bonds. So we think that the majority of a bond portfolio should be in those higher quality bonds. So in general, we would put, for an investor that wants higher yielding bonds or that it's appropriate for, we would put 4/5 in the higher quality and then 1/5 in the more high yielding bonds, with the understanding that high yield bonds, if you think about stocks and you think about high quality bonds, high yield bonds sit in the middle. They're less risky and less return than stocks, but more risky and more return over time than high quality bonds. And so we think of it as a hybrid asset class, and that's how we think sizing it makes sense. If you think that that's something that makes sense for you, certainly talk to your financial advisor about, your cash flow and your risk tolerance and stuff. And, you can see, if it's something that makes sense to put in the portfolio, or let them know. And I'm happy to jump in the conversation as well.
Perfect. 2 more questions at the moment. There are 2 sectors contributing to inflation: consumer spending and government spending. Government spending and plan for spending is incredibly high. The government also controls both their spending and the cost to consumers for spending. So what can a consumer do other than vote?
Yeah, I mean, I don't know how much I have to add to that. Yeah, I mean, if, obviously the government spends, so roughly 70% of the economy is consumer driven, and then, the government is whatever share. So consumers are a much larger share of the economy than the government. But everybody's got their own view on, both how much the government spends and then also what they're spending it on. And, I think voting, there's a variety of other political mechanisms, obviously contacting your representatives, online petitions, et cetera, that can potentially enact change. But, I think it starts with voting. I don't have any particular, unique wisdom on how to enact change in policy other than that.
Next one is quantitatively, how much does tax loss harvesting typically benefit a pure client? I note it is a sound practice and wondering if during this historical downturn, whether it will make a significant impact on a client's bottom line to somewhat offset the losses of the overall account value.
Yeah, that's a great question. And I think the answer is yes, it will make a difference across the board. I mean, obviously the effect's not going to be uniform. If somebody has all their money or most of their money in an IRA and just a small taxable account, the amount of tax loss harvesting is very different than somebody that has a lot of money in a taxable account where there's more opportunity. Similarly, somebody that was closer to neutral on their cost basis or had less gains baked into the portfolio might do more tax loss harvesting than somebody that has large embedded gains already, and can't necessarily tax loss harvest. I don't have the figures off the top of my head. I know at one point, this is much earlier in the year, we had harvested some 50 something million dollars of losses, but that's going back a ways. We had actually discussed, I know that we sent out the quarterly letter along with your statements. You all should have received it at this point. Our plan is to look at what those numbers are at the end of the year and quantify them at that point and kind of distribute that information. So I don't have the exact figures, but again, for some clients it's quite meaningful. And and frankly too, and this is jumping ahead to my summary of this, it's like there's only so much anybody can do about the market, or very little, right? Ourselves included. And it gets back to making lemonade out of lemons, or whatever your mom told you. And it's like nobody really enjoys volatility in the market or down markets, but to the degree that you can do things like tax loss harvesting, maybe processing larger Roth conversions, or processing it at a different time in the year, right? If you're transferring 100 shares at a value that's 20% lower than it was a year ago, well, that's 20% less tax you have to pay to convert the same number of shares. And then when they rebound down the road, that gain is all tax free. And so I do think there are strategies you can use to position yourself well for the future.
All right, so let's get back to the presentation. And again, if you have any further questions, just type them into the Q&A.
I think the one thing we need to focus on, or it's helpful to focus on, is what time does to returns. And so it's really easy, especially in our society these days, to focus on the immediate, the latest tweet or news headline or Facebook or whatever it is. And when you look at the 1 year performance of asset classes, if you look all the way on the left of this slide, you can see bonds have been as high as 32% in a year, or as low as 11.5%, which was actually this year. You can see stocks have been up as much in a year as 162% and down as much as 67%. And then a 60-40 portfolio in its best year was up 80, and its worst year was down about 45. Right? And that's 1 year rolling performance. When you look at that now over 5 years, right? So now you're getting into a more reasonable time horizon. Bonds have never lost money over a 4 or 5 year time horizon. I think that's pretty important to point out, right? The worst year for a 60-40 portfolio, and I want to be clear here, not all of you are in a 60-40, not all of you should be. This is just a number. We don't blanket put anybody in 60-40 or any other mix. It's really based on what you want. But this slide needs to show some mix, and it happens to be 60-40. When you look at a 60-40 portfolio, the worst 5 year performance is down 7.7, as opposed to the worst 1 year performance is down 45. Right? And if we stretch it over to a 10 year rolling period, the worst performance is basically flat. Right? So I think that speaks to the idea that, again, part of the job is just to figure out a strategy, a philosophy you can live with it and stick with it, because time really does contract those average returns. And that's really what you're trying to do. Is our goal, I mean, quite honestly, is to lower the ceiling on your investment performance sometimes. I mean, that sounds strange to say, but we're not trying to get you 50% a year. But we also want to raise the floor so that over the course of multiple years, your floor is coming up. And what we found in doing this for a long time and with a lot of clients is that it's that fat middle that gets people the investment performance they need, right? It's not getting 50%, but it's also not getting minus 50. It's getting over time those mid-single digit returns that are what we're modeling to the plan anyway, and then making sure that you stick with a strategy likely to get that across time. So we get asked, like, are we making changes to stock allocation? And we just had an investment committee meeting last week, and we talked about this. So I want you all to know that this is something that we talk about all the time. We don't just kind of sit there. We had a long conversation, and we looked at a bunch of research. And at this point, we didn't make any changes to the stock allocation, but here's why. We're in a rising rate environment, right? And there's fears of recession. And so we wanted to look at those two scenarios. And so we looked at, okay, what's happened after a recession? If we are in a recession, what happens after a recession? Well, look at the left-hand side. These are different kinds of stocks, right? Small caps, mid caps, large growth, large value, et cetera. The best performing kinds of stocks, if you come out of a recession, are small caps. Well, our portfolios are already weighted towards small caps. I don't know if I want to go make a lot of changes if we're already somewhat overweighted in a category that historically has done the best coming out of a recession. we're also in a rising interest rate environment. So do we want to make changes there? Well, when we look, here's during rising rate periods, right? You've got large company growth on the left and large company value in the middle. Well, large company values outperformed in rising rates. Then you've got mid-company growth and mid-company value. And you can see that in rising rate environments, mid-company growth has, or excuse me, mid-company value has outperformed. And so it's like, we're in a rising rate environment, we're overweight value. Well, the history tells you that is the place to be. We may or may not be in a recession. If we are, at some point we'll come out of it. We're overweight small caps. History tells you you want to be overweight small caps. So we looked at this and we'll continue to look at it. But at this point, we were like, well, if we were going to make changes, it would be to shift the portfolio to kind of where we are now anyway. So we didn't necessarily want to make changes. Yes.
2 slides back, we have a question. What would that slide look like for a 50-50 portfolio, if you happen to know off the top of your head?
I'm pretty good, but I don't know off the top of my head what it would look. I could tell you what it would look like. The bond and stock numbers wouldn't look any different, right? Because those are just stocks and bonds. The purple column, what you would notice is that in each of these, the ceiling would be a little bit lower and the floor would be a little bit higher. I don't know the exact numbers, but maybe the 1 year rolling, maybe the best year instead of 80 would be 70, and the worst year instead of 45 would be 36 or something like that. And then, same thing with like 5 year rolling. It might be the best would be 20 and the worst would be 6 or 5 or something like that. So it would just take a little bit off the top and a little bit off the bottom.
All right, back to you.
When it comes to bonds, and somebody brought up a really good question before about high yield bond and should you own those? And again, I think that's personal choice and making sure you understand what you own, that they are riskier than high quality bonds. They do provide higher returns, and so it's a trade-off, like everything in investing. We focus on relatively short-term bonds, right? And when you look at this red line, this is 10-year treasuries. And the red line, as you can see, has come up quite a bit since 2020. But look at the blue line. The blue line is 2-year treasuries, and those yields have come up even more. And in fact, are actually higher than 10-year treasuries right now. And I think this speaks to the kinds of bonds that we want to own. Is we still think shorter term bonds make sense in this environment, simply because the yields are comparable to long-term bonds. But we still want to have some intermediate. We don't want to go all into ultra short, simply because short-term rates are so much more volatile. If they come down, let's say rates fall at some point, right? Let's say we do go into a recession and rates fall. Well, if you have a 2-year bond that's going to mature and you're not going to get that income anymore, you're going to get something less. Whereas if you have some 10-year bonds, you're still going to keep that 3.5% or 4% coupon for a full decade or something like that. So we still think having a balance of short and intermediate term bonds makes sense, where appropriate, sprinkling in some of the higher yielding type stuff. But again, we across the board, we like bonds a lot more now than we did a year ago, just because you can get so much more yield from them. And starting yield is a really good determinant over time of what kind of returns bonds will provide. Let me, like I said, I had one more slide with kind of making lemonade out of lemons. And these are just some kind of high level takeaways about when you get in an environment where markets are lower, you reassess your risk tolerance, rerun your cash flows, right? Talk to your advisor if you're worried. Again, when your plan was set up, we knew that markets were going to fall. We didn't know exactly when, we didn't know what was going to be the cause, et cetera. But the assumptions for returns and everything else that are in there include down markets just like this. Tax manage your non-retirement accounts. Again, that's tax loss, tax gain, harvesting, et cetera, focusing on what kind of investments you own there. Roth conversions could make sense. Put excess cash to work, right? I mean, if you have excess cash, again, I don't have a crystal ball, but I'd rather buy stocks down 20% than not down 20%. I've said this many times, but when people used to go to malls, and I understand nobody goes to the mall anymore, but when people used to go to the mall, if you went on a Wednesday in mid-November, nobody was there. You go on Friday after Thanksgiving, and people are literally having fistfights to get in the doors because everybody loves a sale in every area of their life except investing, right? If it's 50% off, 20% off, whatever it is, I'm willing to beat somebody over the head to get through the door first to go buy that TV. But if you want to sell me stocks 20 or 50% off, I want nothing to do with them. I mean, that's to me one of the great ironies of investing. And then the final takeaway is go walk the dog or whatever it is that you enjoy. A lot of times staring too closely at these things will drive you crazy. Again, markets do what they do, and I don't mean to minimize it, But we do think portfolios, and again, we just had this discussion in depth last week. We think we're well positioned going forward. And the reality is this too shall pass. Right? The economic cycle will change. Inflation will come back down. The news out of Europe will improve. And then markets will go up again, just like they have the last few days. I mean, and the irony too is that there's no real material different news yesterday and the day before than there was on Friday. And yet the Dow was up like 1,000 points in 2 days, right? So sometimes markets just go down and then they just come back and go up. And if you focus too much on those minute-to-minute movements, it'll definitely give you indigestion. If you have questions, if you're concerned, again, reach out to your financial advisor. They really know your plan and your details the best. Talk to them, have them look at your plan, dive in, make sure you're taking an appropriate amount of risk. And if there are additional questions or you want to dive deeper on anything we've discussed, just let your advisor know. I'm happy to chat too. We're all here for you. We realize that although up markets and down markets are both part of the deal, like we talked about, bull and bear markets, it's a heck of a lot more fun when markets are going up, but that'll happen again at some point. So keep your seatbelt buckled and let us know what questions you have and how we can help.
Excellent. Brian, thank you so much for the time today.
Pleasure.
All right, everybody have a great day. Thank you.